Thanks everyone for joining this session and for joining the Bruegel annual meeting, which is our flagship event. I am really happy to be chairing this panel with a set of really exceptional speakers. So my intention is to speak as least as possible, to leave all the time to you and hopefully to the many questions that will come from the floor and from our online participants. So we're going to talk about the priority agenda for the incoming Commissioner for Financial Services. And just to kick this off, I think I'll say something that may be controversial in the sense that not everyone probably agrees with it, but it's the opening line of our financial sector memo, which you find on page 97 of our memos book. We think this is really one of the most consequential portfolios in the entire European Commission. So the portfolio that in the past 2 terms has been labeled financial services, financial stability and capital market union is one of the areas where the gravity center of decision making has clearly and consistently been shifting towards the center, towards the European level, as opposed to the national level. So in this respect, this is something really exceptional, and it makes it a very powerful and very consequential portfolio. Now, something that's also interesting is that we, Nicolas and I wrote a similar memo for the Financial Services Commissioners exactly 10 years ago, in 2014. So it's our 10th year anniversary today. And when we look at the content, the challenges that were identified in that memo 10 years ago, and the policy recommendations that were put forward 10 years ago, I would say a good chunk of what is in today's memo is something that carries from 2014. So there has been momentous change in financial services at the European level, and this obviously has been triggered by major events such as the global financial crisis, the Eurozone crisis, and more recently by the EU very ambitious climate pledges. But a lot of the business that was already identified 10 years ago remains open, remains unfinished. So 10 years on, it's a bit of mixed feelings in this memo, where we look at all the progress that has been done, but all the things that still remain to be done and all the areas that remain to be completed, including new challenging areas such as sustainable finance that has seen a lot of regulatory activities in the past years on the back of the EU climate objectives. So to kickstart our conversation, I will ask Nicolas Véron, my co-author for this memo and senior fellow at Bruegel, to give us a brief introduction about what the challenges are, what the policy recommendations are, and where do we stand right now. Thank you.
Thank you, Sylvia, and thanks for the journey together. You mentioned the one 10 years ago, this one again. It's actually interesting to do this thing at regular intervals every 5 years.
Does it?
Because it's an excellent device to see what has changed and what hasn't, as Sylvia mentioned a minute ago. And really, the watershed event was banking union, the single supervisory mechanism, because that's when the proof of concept was provided that the notion of supranational supervision in the EU is not utopian. It can be implemented, it can be made to work. We can discuss how transformative it has been. Bruegel also just published a book on banking unions that I authored, which goes more into detail about this. But the point is, in pure terms of prudential supervision, for the sake of the safety and soundness of the banking system, the European banking supervision, the single supervisory mechanism, has been effective. It has worked, and so far. So from that perspective, this completely reframes the debate on financial services when you compare to where it was a generation ago, when Mario Monti launched the Financial Services Action Plan in 1999, or even earlier discussions. There was always, actually since the 1960s, at least, this idea that supranational supervision and enforcement of the harmonized regulations could be useful, but there was no confidence that it could be made to work. Now we know it can be made to work. And therefore, there has been this shift of the financial services portfolio generally, that it's no longer just about regulatory harmonization, it's about integrated policy. And then it's a question of how far to go in terms of, in a way, finishing the job and creating a framework that is conducive to a genuine single financial system for the Eurozone and beyond the Eurozone for the European Union. But we believe that this framing is important because indeed it has evolved to a certain extent over time, even so some of the challenges are still there. And it's also very different from other areas. If you take, for example, energy, this breakthrough of moving from legislative harmonization to a single point of implementation, enforcement, administrative authorizations, and implementation has not happened yet in areas such as electricity and gas infrastructure, and that's a major difference. So I'm not going to go into the detail of the memo. I encourage you to read it. I will only say that compared with not 10 years ago, but 5 years ago, the first von der Leyen Commission has had some important achievements, and I think one of them is not sufficiently sung in the area of financial services. It's a really groundbreaking work that has been done in terms of anti-money laundering supervision. So you can call that, in a way, the little sister of European banking supervision. It's kind of the same concept. Create a European-level agency, in this case AMLA, the AML authority in Frankfurt, which is starting its work now, and put it in charge of consistency of implementation of the harmonized regulatory framework. And that introduces a debate on capital markets union, because our argument is that the same concern about consistent implementation of harmonized legislation actually drives a lot of the capital markets union action or inaction. And therefore, we very much go in the direction of doing for capital markets what has been done for bank safety and soundness, and giving the EU framework the capability to have a consistent implementation, which does indeed mean integrated supervision. We have a lot on sustainable finance, better definitions, clarity of purpose, definitions of sustainable investment, definitions of transition finance. I think we're kind of in the second round of discovery of what the initial legislation on sustainable finance, to that I'm sure, I don't want to be too long. I just want to end on a note about global standards. The European Union, and this connects with the larger themes of this Bruegel annual meetings and about the changing context we experience in the international area, geopolitics, globalization, or different trajectories. It's impossible to overemphasize how much the EU has benefited and has to benefit from global standards in finance. This is essential for us because our single market is built on the concept of supranational regulation and legislation, and we need a degree of global consistency to be able to do that inside our European single market. The EU has had tremendous success in terms of showing leadership in the adoption of global standards and helping the rest of the world get there. Accounting standards is a prime example. And that vision should not be lost even in the challenging geopolitical context we have now. And there are issues where I think we could do better, one of which we don't mention in the memo, Sean. I don't know if we ever discussed that, but things about legal entity identifier, about tagging financial services firms or other firms so that we can avoid some getting through the nets also for things like sanctions, trade, tax, and a number of other policies that go well beyond finance, but where the regulatory financial stuff can have a lot of catalytic effect. Let me stop here, looking forward to what we will hear from the other panelists.
Yes, thank you so much. And I actually would like to pick up your point on the global perspective, because of course EU regulation does not exist in a vacuum. And one of the issues that has been discussed and keeps being discussed is performance against the US, both in terms of the performance of the European and US economy, but also in terms of the investment gap that we do see in Europe compared to the United States. And so I'm so happy to introduce François Villeroy de Galhau, Governor of the Banque de France, who will give us his perspective on precisely this very crucial issue. Thank you for being with us.
Thank you very much, cara Sylvia, cher Nicolas, and dear friends, because I have seen many friends in the audience. Let me start saying how delighted I am to be in such good company this afternoon. And I would like also to take this opportunity to thank Bruegel, really, for its work generally, and especially Nicolas and Sylvia for your memo on financial services. Financial services are obviously a key topic for the future of the European economy, and more generally, for European sovereignty. We all agree about that. Yet, it is marked by what I would call a mysterious and increasing gap, as Nicolas just stressed. To state straightforward, the more reasons we have to go forward on financial services, the less progress we make in practice. And I will try to elaborate on that. And then to be more optimistic, in order to close this mysterious gap, I would like to propose 3 somewhat innovative courses of action, and I will also refer to your memo. About this mysterious gap, let me start by recalling briefly 4 major reasons why Europe should move forward again. And we are not at the end, obviously, of financial integration. First, Europe, and this is my first slide, is still lagging behind. Over the last 25 years, GDP per capita has increased by a cumulative 25% in Europe, which is not that bad, but only 25 compared with 38% in the US. And this has a primary Schumpeterian cause, an innovation gap, which is coupled with a much smaller financial powers, you can see it at the right of the slide, despite fairly similar market size. Second, the need to address climate change is becoming more pressing. Studies released this year, I don't know if you are aware of that, suggest that the damage from chronic physical risks could amount to 15%, 1/5 of GDP by 2050, higher than the 5% estimated so far. Third, obviously, public debt and deficit remain very high in some major EU countries, including mine. In this context, it is imperative to better mobilize our abundant private savings to fund the needed investment. And fourth, geopolitical tensions and political uncertainties remain at a high level, and they call for, let me use this political motto, a stronger economic and financial autonomy or sovereignty of Europe. But meanwhile, we have been slow on measures to enhance European financial services. We have a supervision union, and we are celebrating this year its 10th anniversary. It's a huge success. I don't understate it. But we don't have, let us be honest, a real banking union. Beyond supervision, the first pillar, how to resume progress on the 2 other institutional pillars. Regarding resolution, we should not run the risk of enshrining disparate national procedures. And regarding the third pillar, the stalemate on a fully fledged EDIS leaves it up us to find alternatives. I will come back to it. Furthermore, and this is perhaps less often stressed, without large European banks operating at the scale of the euro area, the banking union has too little substance. The official side cannot, on its own, make these pan-European banks exist, obviously. But we should be, as public authorities, mindful of not impeding their development. Cross-border mergers across the euro area have been few, small, and all but transformative in the last decade. Even if I look at the European wholesale market, where financial integration is effective, European banks are not leaders, to say the least. Among the top 10 banks generating the bulk of investment banking fees in Europe, there are only 3 SSM banks accounting for less than 30% of these fees, while US banks bring in 55% of investment banking revenues, and this figure has been steadily increasing. One last word about the Capital Markets Union. We all support it, but let me say it this way, it has proved insufficiently galvanizing from a political standpoint, and this is probably a euphemism. This gap between reasons for actions and progress on action remains a bit of a mystery. Jean Monnet, this has been very often quoted, predicted that Europe would be built through crisis. And Europe has not faced a financial crisis since 2012. It's per se obviously good news, but it would be too heavy of a paradox if the financial security created by our efficient supervisory union prevented Europe to move forward to an efficient banking union. And this has perhaps some truth in this paradox. So let me come to my second part, how to change gears and boost investments in priority sectors for long-term European growth, and share today with you 3 key and I hope somewhat new ideas. First, regarding the deposit guarantee, we have to work on more targeted solution than a fully fledged EDIS. In the words of my German colleague and friend Joachim Nagel, a hybrid model would offer multiple benefits over a purely European centralized model. We could indeed keep the current national schemes with their autonomous decision-making, as permitted by the Deposit Guarantee Scheme Directive, but fully in line with the subsidiarity principle, we could build a European support scheme for DGS as a liquidity backstop when a DGS own resources would be put under excessive strain. I support this idea, provided we bring some technical clarifications. I will not enter into detail. Introducing this new common safeguard would pave the way for renewed discussions on waivers and cross-border integration, which are much needed to achieve the banking union, and here I can only regret the behavior by some so-called host countries. Second idea and lever, refocusing the purpose and content of CMU. Here I will be very quick because we all share the purpose. The objective is very clear. We must unlock the funding needed for Europe's twin transformation, green transformation and digital transformation. We have the private resourcing. This is the right part of the chart. We have significant funding needs, the left part. CMU is channeling these European resources to European needs. So it's an allocation objective rather than mere stabilization objective, which we tried to solve together 10 years ago. It calls for rebranding, and here I follow the letters report. Capital Markets Union is probably too technical of a brand, as a savings and investment union. And on its content, let me express it this way, let us try to replace a long list of small technical items by a short list of big items. I would quote 3 of them: green securitization, venture capital, supervision. A brief word on each of them. Green securitization could boost banks' capacity to finance green projects by several hundred billion euro a year. And as advocated by Bruegel's memo, our green transformation could also benefit from a clarification in the EU legal framework of what we mean by sustainable finance and transition finance. Venture capital. We should develop a more ambitious public-private partnership with pari-passu co-investments. We have some examples outside of Europe around the EIB, in particular to close the financing gap for scale-up companies. And I also concur with Bruegel's memo to advocate a genuinely European supervision. ESMA could exercise single oversight, or at least joint oversight, over cross-border players, including certain market infrastructures, CSDs and CCPs. Let me come to my third idea and spend 3 minutes of them because you are probably less familiar for it. But I would strongly advocate an innovative strategy on payments to be part of our strategy on financial services. Why so? Let us be honest, payments have too often been considered as a technicality, a boring and back-office issue. We should definitely change our view. This field is highly innovative and more competitive globally. So it's strategic, and we need a European strategy which could reinvigorate banking union and capital market union. I don't want to be too technical, but let me comment very briefly on this slide and its possible evolution. This is a description of the present landscape. You have payments in the top left corner, you have financial markets and institutions, and then you have European services, target services provided by the Euro system. At the bottom, this is outside of the euro area, what exists elsewhere. If there are some specialists of payments in the room, it's oversimplified. It could be worse. But let me try how we should evolve there. And let me start with retail payments, which are really the top left corner. Here, we need to address fragmentation of multiple schemes and increase our strategic autonomy. The Euro system welcomes private initiatives, and I added in green what should be added and innovated. Private initiative is the so-called EPI, European Payments Initiative, with its Wero portfolio. And we should focus our own efforts of what I call the last kilometer, the front end. We have TIPS. This is a decisive European asset, for instance, payments, but we don't have yet harmonized front-end payment solutions. I don't know if you are aware that some emerging countries like Brazil and India have met this challenge in the very latest years through enhanced fast payments system. In the euro area, the Digital Euro project, which I have put here on the left, could also help for this last kilometer. Furthermore, in line with the G20 roadmap, we are set to reduce the frictions, delays and costs in cross-border payments, still retail, including by interconnecting, and this is the last green figure, green line at the top, interconnecting TIPS with other fast payment systems. Let me come to wholesale and financial markets, which are probably still more important. Less in the public debate, but here we should develop a new type of market infrastructure to meet this growing demand for tokenization in finance. I reassure you, this is my last slide, but the most sophisticated one. And you see this new green part, what we could call a DLT-based, DLT is blockchain, European Unified Ledger, namely a new public-private infrastructure built around a distributed ledger that would include a wholesale central bank digital currency, wholesale CBDC, tokenized commercial bank money, you can see it in this green rectangle, and tokenized financial instruments and securities. Potentially a link with the digital euro retail later on. This shared infrastructure, and it was elaborated in the BIS report June 23, at European level, would streamline transactions, reduce risks and costs, and thus really foster CMU. Not very often mentioned yet. The transition towards a unified ledger would nevertheless not be a big bang, as current target services in Europe, which remain on the left, already provide state-of-the-art services for most use case. Think of sovereign bonds, for instance. But a phased approach could start with a wholesale CBDC for specific market segments that currently are market failures, so to say, rely largely on two manual, domestic and heavy processes. Think of mid-sized companies financing, ESG instruments, or usage subscription. And it would gradually evolve to a broader range of tokenized assets. I will conclude here and we will have the discussion. But coming from Paris, let me conclude with the motto of the Olympic and Paralympic Games, and you know it: faster, higher, and stronger together. To achieve this, the three ideas I have put forward for European financial services could hopefully be key levers for or towards a comprehensive and innovative savings and investment union in our Europe. Thank you for your attention.
Thank you, Governor, for highlighting this very deep structural, architectural changes that may be needed. I will actually start from there, and I would like to turn to Mr. Alvarez to ask you something. So the Governor highlighted the existence of an investment gap between the US and Europe and between the activities of US banks and European banks. I would add another gap, which has been consistent in the past year, which is the gap in valuations between American banks and European banks, with European banks being constantly undervalued compared to their US peers, despite the sector having undergone a very strong restructuring and a deep strengthening of balance sheets. And we know all this from what happened after the global financial crisis. So my question to you is, why are, in your view, first of all, is it true that European banks are not investing enough? And what are, in your views, the priorities in this area for changing this? Do you think the three ideas put forward in the governor's speech might be helpful in terms of turning things around for the sector?
Okay, thank you. Thank you for having me in this conversation. To change a little bit the topic, this is not a politic topic. It's true that European banks are trading well below American banks by any measure. In the different multiples, BNP, being price to tangible book, they trade far below American banks. A couple of years ago, before the interest rates start to go up, 2 years ago, 3 years ago, was a pretty good reason, yeah? Profitability in European banking sector was very, 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 very weak. So return on equity at that time probably was in the region of 6% or something like that. And this is explaining a little bit the situation of different valuations. But there is another angle that the Governor Villarroel mentioned, that is competitiveness/growth. So the market investors were assigning the US market is superior growth compared to the European market because the European market was losing competitiveness because the relative specialization of the economy in Europe. Europe is not participating in the development of the new technologies, very little compared with Europe is not in the cloud, Europe has not developed social networks, in the AI, Europe is not participating, and these are drivers of future growth. That means that not only the banks, but especially the banks, you assign less growth to the banks. Having less growth, the academy and those who are academics, means that your cost of capital goes up. And this explains the current situation because the European banks catch up basically with American banks in terms of return on equity after increasing rates. Now, the banks are moving in double digit. Others are in the high double digit and some of them above 20%. Even those, like the one in which I work, are in high double digit, they trade below book. That in principle means that the cost of capital goes above 20% or around 20%. That is why the cost of capital is so high. So, and the one explanation, potential explanation is growth. They don't see growth. And I tend to think that this is the case in Europe. The market is not expecting growth in Europe because they are not seeing the European economy being very competitive. This is one reason, growth. The second one may come from the fact that European banks, more than American banks, are losing more market share in areas because we don't have developed capital markets. The model, and Governor Bill also mentioned why Europe, American banks have significant market share, while in America the European banks are not able to make a difference. We have here the role of the capital markets. In Europe, capital markets, at the beginning in Europe, I remember, I don't know, a couple of years ago when we were discussing capital markets, many people thought that the banks were against capital markets. Yeah, because they compete with the banks. No. Having strong capital markets allow the banks to be more proactive in the investment process of the economy. And this is important. For this reason, it's important that we develop what is called capital market union, whatever. Securitization in Europe is not there. The origin of the last financial crisis was securitization in the US. The model originated to distribute. There were plenty of casualties in the US, but the market that was dead was the European one. So the American market recovered very quickly. Securitization is not yet recovered in Europe. So we have the growth, we have no capital markets, and we have the fact of scale. So big American banks have a scale that allow them to be tremendous supermarkets acting in every corner of the financial world. In Europe, even the large banks, we are large because we operate in different markets in an isolated way. So, for example, Santander operates basically in 10 markets, but we don't have an integrated operation. Even inside the Eurozone, we are a market leader in Spain, we have a market leader in Portugal, also in Poland, but we still keep the subsidiaries, the local subsidiaries. Why is that? Because the banking union doesn't exist. The single market for financial services doesn't exist. Why? Consumer protection, bankruptcy laws, systems, plenty of things that when you are the CEO of a bank and you are thinking in doing a cross-border transaction, you are not able to find the cost synergies to justify the premium you need to pay in the market. And this is also a reason why the European banks trade below. The market doesn't assign you the capacity to consolidate and to extract value out of this consolidation, both in terms of being more efficient and in terms of having more reach in the market. So I would say the combination is with three things. I didn't mention regulatory wall and supervisory wall, although I don't know if I should. So in the last 4 or 5 years, the number of regulations in Europe is that came to as mandates to the European supervisory authorities, the number is 440 regulations in 5 years. This is quite a burden, okay? And all of them have in common that every time that comes a regulation, a banker always thinks more capital. Because every regulation then translates into add-on in capital. Well, there are problems that are solved with capital. There are problems that are not solved with capital. And in fact, we saw a very large bank, European, not the European Union, falling apart with a 14-15% capital ratio. Yeah, so we need to address also this issue. So this combination of lower growth, competitiveness due to the scale being lower, and the prospects for the future being poorer probably is what justifies, in my view, the different valuation of European banks. Some people say that we're going to keep losing market share all the time. Yeah, as a matter of fact, also Governor mentioned payments. We lost massive market share in payments already. So we are losing market share also, even in the most plain vanilla credit. So when you see the private equities coming to the banks to buy credit, it means that something is wrong. So if the banks that were built to gather deposits in order to make loans, and there is someone else in the market operating the wholesale space that can buy those loans from the bank's balance sheets, something is wrong there. Yeah, so the only difference I see is maybe you can think that the private equities are smarter than the bankers. Well, maybe it's possible, but not in general. So the only explanation is the capital regulation probably is too tough with banks, and the aversion of risk is due to this is too high. Yeah? So this is my view. Yeah.
Thank you. Before moving forward, I just wanted to remind everyone that you can send questions for the speakers using online application. There should be a QR code, maybe if we can project it also on the back, and we will ask your questions at the end of the session. So by all means, please do send in your questions. But speaking about new regulation and EU regulatory activity, a lot of the EU regulatory activity in the past 5 years has been in the area of sustainable finance, with the idea of effectively leveraging the allocative ability of financial markets behind the EU climate goals that are obviously very ambitious. And the EU is at the forefront of sustainable finance regulation in the world, among other global jurisdictions. So I wanted to ask Professor Monasterolo, who's joining us from the Utrecht University and is really an expert on climate finance, whether we are going in the right direction in this particular field that obviously is extremely important, both for the financial implication, but also for the real economy implication, because ultimately we are talking about the transition of an entire economic model.
Yeah, thank you. And yeah, let me bring a bit provocative ideas, since I'm representing the science here, or research at least. First of all, I mean, there has been growth in sustainable finance, but we tend to forget that there is no sustainable finance if there is no sustainable economy. And in order to get to a sustainable and climate-aligned economy, science has been quite clear about, for over 14 years, I mean, I started working in climate finance quite 15 years ago, so, and since then there were reports of the Intergovernmental Panel on Climate Change, scenarios of the Network for Green Financial System, which are the ones now used, and to one also Banque de France is contributing. So the point is that the science was clear about where we should invest in which kind of activities, and these are activities that are pro-climate, so activities that are not only low carbon, but contributes to preserve natural resources which are endangered both in quantity and quality by climate change, and where we should not invest. I mean, there are clear trajectories in the scenarios about which activities should go up and which activities should go down. And which activities should go down are not only fossil fuel, which are, we could think of that, of course, through time and with differentiation about sources, but also activities that are high carbon and that actually negatively contribute to and negatively affect natural resources and our real source of living and of all other economic activities, because we are, our economic activities build on ecosystems and biodiversity. So all activities that negatively affect that and that destroy productive capital in different parts of Europe, this, should not really be pursued. And then we ask ourselves, okay, why? With all discussion we had and regulations about sustainable finance, is money still not getting there? Because, as the governor remembered, there is a big gap, and there is also a big gap in climate finance. And I would like to bring 3 insights from research on this. The first one is lack of policy credibility and coherence across policy domains, so what we do with one hand and what we do with the other, because this is fundamental to affect expectations. Expectations play a big role in finance, and investors decide how to adjust the risk assessment for different activities based on their expectations. Expectations are affected by policy credibility and coherence. And this is a major point, because climate risk is endogenous. So the climate risk that we will face tomorrow, in 10 days, in 10 years or 50 years, depends on the policy decisions that we take or not take today, their characteristics, and this affects investors' expectations and reaction. The second point is about metrics and macro-financial models that we use. This should be actually science-based and should be able to contain the characteristics and embed the characteristics of climate risk. So when it comes to metrics, in Europe, we developed the EU taxonomy on sustainable finance, which should, sustainable activities, which should tell us which are the activities in the economy which are green, but this has been somehow adapted through time and is affected by political decisions. So investors need clear and, let's say, science-based information about what is green, but also about what is not green to inform their investment decision. And Europe was at the forefront on this, but let's say momentum should be kept and should be credible. On the other hand, we have macro-financial models that are still struggle, and also those used as central banks, that still struggle to account for the characteristics of climate risk, that being endogenous is characterized also by non-linearities, and then we might have heard about deep uncertainties, tipping point. I mean, we are not really able to predict what will happen in the future. It's such certainty, so we need to be prepared to work against also with scenarios. And these scenarios, when coming back to investments, should tell us that we should focus not only on the short term in terms of investment policies, but on the long term, because the long-term effects that we expect from climate change, some of the long term that we believed would have occurred in many years, are already here in several parts, even of Europe. So the long term is collapsing in the short term, and we are moving from thinking return periods of 1 to 100 in 1 to 500. So investments should be long term, and should be investment policies and investment should be long term. Long term meaning not 5 or 7 years, but well over 20 years to have an idea and to anchor expectations, and be based and informed on proper models for risk assessment. Otherwise, the money, and this is the third point, and with this I will conclude, that we are going to create in order to, and we should create to finance climate mitigation and adaptation, this actually, the money will not be effective. It will be new debt in some forms that will not reach the target, so, and might be even unsustainable. Because when we talk about becoming competitive against the US, we talk about competitiveness that should consider climate, how to retrofit our economies to be climate-proof, and preserve fiscal and financial stability. And these things go hand in hand, because it's not a linear path, but there are feedbacks between climate, the economy, and finance, and feedbacks and non-linearity. And the third point is money. We need money in order to be credible. We need to allocate reasonable amount of money. In recent research also we showed that money for adaptation in Europe is not enough. And this money, we also show that it's much better in order to inform investors and anchor expectation when it's issued jointly, because all countries need to invest in adaptation for different reasons. They are affected by different types of hazards. And if they don't do, actually this negatively affects our common economy, and with implication on fiscal sustainability and on what we call the sovereign, climate sovereign and bank doom loop. So with this, I would conclude.
Also for bringing up the issue of how green growth may actually be different from the kind of growth that we know, which is a topic that is dealt with in other memos. So if you're interested, you can read more there. Last but by no means least, I'm turning to Director General of DG FISMA, John Berrigan, the man everyone wants to hear from on this topic. So, lack of policy credibility and consistency, is that an issue? Obviously, not just related to sustainable finance, but more broadly about all the themes that we have talked about so far. And what are we going from here in the next 5 years?
Thanks, Sylvia. And let me start by saying that I do not know who the identity of my new commissioner is. So please don't ask me on the way out, and if I did, I wouldn't be allowed to tell you anyway. So you just have to wait another week. But that's a problem for me because I'm 1 week away from knowing who my new boss is, and that means I don't know who or he or she will be, or what he or she will think about financial services. So I will say things today which are largely on my own account. I don't want to be back here next week contradicting myself, so it will be very personal. It was nice of Sylvia and Nicola to say how important the financial services portfolio is. I suspect you say that to all the Director Generals you meet.
No, Sean.
I will.
Only my former boss.
I'll be sure to tell my commissioner that he's got a very important portfolio. I mean, I listened very carefully to all the fellow panelists and speakers, and it's important in financial services, which is such a wide and complex field, and such a politically sensitive field. Many of the commissioners who come on their first meeting think they've got this very technical portfolio, and you have to explain to them that this is one of the most explosively political portfolios, but the politics is in Article 6, Paragraph 4, Subparagraph 1, Line 2, where we put some number in which has caused a big problem. So it's a very political thing as well. And it's important, therefore, to listen to all the different perspectives. And I got a little bit of listening today, the sort of situation the Commission finds itself in, because there are strong views on all sides of this argument, and I'll come back to that in a minute. But maybe just to set a few remarks on a broadly personal basis. I mean, as ever, the priorities of the next Commission, I think, will be dictated by the context. And the context for this mandate is really radically different from the context 5 years ago. Now we have a geopolitical situation which is highly stressed. We have globalization, if we're lucky, not in total decline, but certainly in reverse. We have a structurally weak economy, which is not new, but the focus now is clear on our productivity performance, which is, I have to say, the chairman of the Fed has a chart, which I think he likes to show Europeans, which shows the gap between US and European productivity, and he has it in, not in landscape, he does it in portraits, so it's even more dramatic, but it is very dramatic when you see it. I think there are also structural challenges still in the banking system, so profits are recovering, that's great, but some of the old structural problems and then some new structural problems are emerging, which may also, these two things combined, I think, may explain the book valuation for European banks and why it hasn't just recovered back to 1 because of profits. And then lastly, I would just mention that it's the fading influence of the global financial crisis. It used to be that I could walk into a room in the Commission and say, I need this for stability reasons, and that was all I needed to say. Or I could say the G20 thinks we should do this, and we would do it. This is not the case anymore. As growth and competitiveness moves to the centre, people in our business will have to start justifying what we're doing, I think, in a more, let's say, articulate way than we may have had to do in the past. I don't want to focus on these structural challenges, these contextual sort of issues, just one about the structurally weak productivity performance, because that's where I think in the next Commission, the focus will shift from stability for financial services to what is the contribution the financial sector can make. Now, I need to be careful here because we promised not to fall into a trap of deregulatory cycles. So I constantly make the case that I think the financial sector can make a big contribution, but we must not do it at the cost of stability, because the precondition for any positive contribution is that the system is stable. If the system is not stable, we see what it does, and it's not very positive. So we won't take risks with stability, but that being said, we still have to engage in this debate that the politicians want to talk about, and rightly talk about, which is growth. And if you strip this down to back to your Economics 101, this is growth as a function of productivity and savings or thrift, as we were all told. We don't have any problem with savings. But we have a big problem with productivity, which suggests that there's something wrong with the intermediation of our savings into investment. And that, I think, is where the banking union and capital market union are going to move into focus. Because if we're going to contribute effectively to growth and competitiveness, then CMU and banking union, or, and Francois, I'm sure, are really happy, the savings and investment union, because it was really his idea, I think, to begin with. He won't admit it, but it was really his idea, that this has now come into the forefront. So this will be a big reform, I think, a big contribution. But let's be clear, it will not be the only contribution. So if people are putting all their eggs in the capital market basket, they should not. If this is not accompanied by reforms in other parts of the economy as well, it will not be able to deliver. Now, I have to just focus maybe on three things that I heard. Banking union. Well, the story is well known. Initial momentum, fantastic momentum, the speed of light in European terms to get the SSM and the SRM set up, and then it's just fallen away. I think partly because the crisis has faded away. You're probably right, and Monet was probably right before you. I would prefer it not to be that way, because I think it's a very unfortunate way to make progress, to basically take the hit before doing the things that you should have done to avoid taking the hit. But maybe that's the future for Europe still. But where I'll say something, Nicola, I wanted to say to you is that the SSM, of course, is this model of supervision. But what the SSM has delivered so far is stability, but it has not delivered an integrated market, which makes it very hard to intellectually carry that argument into the capital markets and say, oh, if you just have an SSM, your market will integrate. Because the SSM has not resulted in integrated. It should have, but it has not yet done so. I think that's why, the reason for that is because the crisis caused a lot of damage, economic, financial, but most of all, it caused damage politically. It undermined trust between member states. And this undermining of trust is evident in two things: the argument around burden sharing, which for me has always been a nonsense, because we can collectively reduce the burden for everybody, so it's not a one-to-one discussion. And secondly, these home host issues, which are deep-seated and reflect the experience of the past crisis, and we'll need to find a way of addressing those. Now, we have a roadmap. The Eurogroup developed a roadmap. It's very useful because, as the President always says, it identifies the trade-offs. The only problem is we're not willing to make the trade-offs that we have identified, or we don't like the trade-offs that were being offered. You know, CMDI is a good example. We, I think, gave a good proposal from the Commission. Not quite so happy with what's coming back from at least one of the co-legislators, but okay, we will see how it works. EDIS, we have had a hybrid on the table for a while, but there's still no takers. So I think what we need to do there is to, again, reassess all this in the new economic context. We no longer have the luxury of living with inefficiencies. And it may well be that we need a crisis. We may already be in a crisis. Not one like we've had in 2009, kind of acute, as typical banking crisis. This may be a slow-burning crisis. A slow-burning crisis where Europe is in sort of structural decline. And, if we don't break the cycle, our future is not looking great. So I think we may have a crisis. We may have the conditions, if we change our view of the context, to have a different conversation about banking union. I hope so, because if we don't, we could be a little bit stuck. On CMU, this is a long-term project. I should know better than anybody, because I've been doing it for a very long time. We've made a lot of progress, but I will agree with you, it has not been kind of fundamental. And I think we have confused maintenance of the single market with building the single market. I tell this story, and you've all heard it before. When I was with the UK for their first dialogue, we were comparing agendas. Their agenda was almost the same as our agenda, but they have a single market already. So what was the single market part of my agenda? Well, it wasn't. We were not talking to them about insolvency. We were not talking to them about supervision. We were not talking to them about harmonizing corporate law. They have it already. We could talk to them about listing. We could talk to them about prospectus. But these are the maintenance parts, not the building parts. So I think we have to refocus. Of course, the problem with refocusing on the building part is that that's the politically really sensitive bits. Supervision is, as you know, politically sensitive. Insolvency, you have to deal with justice ministers. If you try to tell a justice minister you want him to reform his insolvency law so you can have a capital market, he reminds you that his insolvency law is not there for capital markets only, it's there for other things. So you have to convince him that these other things should take second place. Taxation. We know how member states respond when the Commission talks about taxation. So I think, we need to sort of realize that when it comes to CMU, we have to build a market. We have to build a market because this bank dependency we have, apart from being a stability risk, is not what we need for industrial transformation in 21st century. We need a capital market. We need direct financing for the sort of stuff we need to do going forward. We can always get capital from the US, but there's a sort of value-added problem here. There's a sort of strategic autonomy problem here. So we need to focus, I think, as Francois says, on a few deliverable high-impact. And I think everybody agrees on that. The problem is we don't agree on a small number of high impacts. And again, you end up with possible 25 high-impact measures, which, the Eurogroup statement has a long list of these measures. So we will have to probably choose among them. And the Commission will make its best choice and then get criticized by everybody. But that probably means we are doing a reasonable job. One last point I wanted to make on the CMU, on the Bruegel Memo talks about maybe we should move away from harmonization, focus more on national benchmarking. I don't think this will work, frankly, because what Europe needs is a large shared capital market. It must be big enough to be globally competitive. The risk with national benchmarking is that you drift into a discussion about 27 separate markets. Each member state accepting that they need a capital market, but trying to build their own one. It is not going to lead us to where we need to go. There's probably no European capital market that can acquire the scale necessary to compete globally. Sweden is always put forward as a great example, and it is a great example, but Spotify is not quoted on the Swedish stock exchange. It's quoted in the US. So, let's be clear. We need to share this thing. We don't need to build our own. On sustainable finance, which I have to respond to, look, we were given a deadline, 2050, immutable deadline. Do we fall off a cliff if we go past 2050? So as policymakers, you reverse engineer. In order to get there, you need to put a framework in place very quickly. We put a framework in place very quickly. Is it perfect? Quite evidently not. In the next mandate, I think we will face this choice between consolidating what we have, making it work, and building the rest of it. Because it's not just that we don't have the resources in the Commission, but the market's not capable, I think, of managing these two things at the one time. So this will be one of the choices the new Commission will have to make, how much weight it wants to put on finishing it versus how much weight it wants to put on making it work. I think it's personally, we will probably focus more on making it work, because there's no point in finishing something which is not working already. So we'll focus on clarifying, we'll focus on streamlining, we'll focus on transition issues in particular, which are there but not properly defined. So we have no problems with correcting the mechanism as we see, but we will need to engage with the industry quite actively, and also be aware that there are others who might not be so keen on what we might agree with the industry. So we need to do that without risking greenwashing too much, because that is the risk. And then lastly, because I'm discussing sustainability, I want to just mention burden reduction, because this will be another theme that will run through the next Commission. And sustainable finance is in the sort of crosshairs of that discussion, because it is the new heavy regulatory burden. I suppose the questions we're all going to have to ask ourselves is, 15 years after the crisis, do we need to legislate as much? Does the pace of legislation, which we've gotten used to for 15 years, is it really normal? Obviously, we don't go back to what was there before the crisis, but do we need to be producing 400 pieces of secondary legislation? And I agree. I removed 400, but put 400 more in. So it just keeps growing. Can we be less complex about it? We should be, but it's difficult when you have 27 member states with their own national interests. Things get complicated. And then can we do all of that without compromising the sort of fundamental objectives, whether it be avoiding greenwashing or undermining stability or whatever it might be? So the burden reduction discussion is very important, but it has to be properly framed. We should not fall back into the trap of the regulatory cycle of, working like crazy for 15 years after a crisis, deregulating like crazy for 15 years after that, and then having another crisis and then going off. We need to avoid that this time. We promised ourselves we would. I think we should stick to our promises. I'll stop there, Sylvia. Thanks.
It would be great to have this conversation again once you know who you will, your commissioner will be. All right, so we are running a tiny bit late, but we still have some 10 minutes for questions. So if you, and there are some already, which is great, so please raise your hand and a microphone will reach you. Please identify yourself and state your affiliation when asking the question. And if we can start maybe here in the second row.
Thank you very much. Paola Tama for the Financial Times. My question is for Director General Sean Berrigan. One thing which you spoke about is risk. In the many discussions among finance ministers and lately heads of state and governments, there has been a call for more risk-taking when it comes to investing financial markets. Do you take that to be an invite for deregulation? And if so, would you share it, or how do you interpret it? And how would you decline it in the next mandate? And perhaps connected to that, many financial institutions have pointed at the growing risk in the non-bank or shadow bank sector. Is that an area that in the next mandate the Commission will look at? Thank you.
I go now?
Yeah, sure.
No, I mean, how I interpret the discussion of risk-taking is about direct versus indirect financing, basically. I think there's a realization that many of the projects that need to be financed in a modern economy growing, it's 21st century, so high-tech, they are highly risky. Many will fail, but those that succeed, of course, succeed big. And that the banking system is not well suited to that kind of investment, because people like us actually make sure that they don't take those risks, because they are deposit-taking institutions. So we charge capital around those risky investments. What they want is, I think, more direct financing in the system. So, more direct risk-taking, and that means you have to build a capital market capacity. I mean, as I said, you can get it from the United States. We get it a lot from the United States. The great sort of paradox is that our savings go to the United States often to fund our investments in the United States. This is not particularly clever as a way of economic development. So I think that's what they mean. It's not that they want to wind back, 15 years of post-crisis banking regulation. No. And the second question you asked was?
Non-banks.
On non-banks. Yeah, I mean, non-banks. Non-banks has been a discussion at international level. Francois knows this for as long as we've been sitting around the table. Mm-hmm. We have already done quite a lot on non-banking. If you look at our sectoral legislation, there are already a lot of instruments in there. We already have liquidity tools. We have leverage tools which may need to be improved, we will see. But we have a consultation out, as you know, which is, I cannot commit, but is normally a sign that, at least our advice to the new commissioner will be that this is an area where the Commission needs to work. Now, the problem is how far we can go without knowing what the FSB and the G20 think about this. I'm a big fan of the FSB, but sometimes they can be slow, and we go alone. So we'll have to see, again, with the new Commission, do we wait for the FSB or do we go alone?
If I may add a short remark, and Shannon and I have been long-term serving in this fight of financial services, 9 years for me.
Don't ask.
Okay. And I really want to pay tribute to what you did and what you still do, because there is some kind of financial services fatigue. But without complacency, I think we can say Europe, the Commission, all of us, have been efficient in preserving and strengthening financial stability along this series of crises. And let me stress it, in the last 2 years, because we had a monetary tightening cycle. Remember, 2 years ago, there were serious worries that it would create on the economic front a recession and on the financial front serious stability problems. There was a Silicon Valley Bank crisis, but it was not in Europe, and this was not by chance, and it did not spill over. So I would say that the track record on financial stability is much more than honorable. We shouldn't relax on financial stability. We should not increase requirements and regulation, Jose Antonio. I agree on that. But let us stabilize with Basel III. But the next challenge, and this is really my hope for the next Commission, is to take into account growth, competitiveness, and the allocation function of finance. Because we were focused in the last 15 years, for obvious reasons, on safety, financial stability. But how can we enhance the agenda on the other side of the story, and which is the economic function of finance, so to say, to serve climate change, etc. I strongly hope it can be the agenda more focused also on CMU.
If I may, to react a little bit, to be a little bit provocative, if we want to grow more, we need to take more risk and invest more. So one way or another, we don't want to grow if we don't take additional risk and we are able to generate additional investment. Probably to review some of the things we've done, for example, MiFID. MiFID has a bias to conservatism. So at the end, we treat the citizens like they were minors with MiFID. So they can vote, but they cannot invest their own money. So probably we took a position that comes from the financial crisis, too conservative. And well, at the end, we have what you said. The problem is not the savings are here. So Europe continues to generate a magnificent current account surplus every year, a capacity to invest. But the investment is not here. This is the problem. Why is this?
Definitely a topic for another panel, I think, because we could go on for another hour. But I would like a couple more questions to come in if we can. Already have the microphone? Perfect.
I work for Assonime, the Italian Association of Listed Companies. I have 2 questions for Nicolas Veron on supervision. The first one is linked to the consistent implementation of legislation. We are very much in line with the ideas expressed in the memos of Bruegel. What about going a little bit further, allowing companies to choose ESMA as their competent authority, supervisory authorities? And the second question is linked to the global competitiveness. UK has recently passed a law modifying the purpose of the FCA introducing as a secondary objective the competitiveness. What do you think about the possibility to introduce the same for the ESAs? Thank you.
All right, I can trust you to be concise on this. So meanwhile, can we maybe move the microphone to the other two questions that were raised? Yeah, so maybe we gather all of them and then we do one final round of answers.
Thank you. Catherine Carlson from Politico, and my question is also for Sean. The piece of legislation which at the moment seems the most caught up in these competitiveness discussion crosshairs, as you mentioned, is Basel III. I mean, with the discussions about EU-US competitiveness, we've already seen the FRTB delay in the EU. My question is, in a broader sense, if the US continues to delay, what are the next steps for the EU? Do you think we're going to see more compromises to the Basel rules for the sake of competitiveness? Is this something that, like you said, has become sort of out of your hands?
Thank you. All right, if there's no one else who wants to... Okay, last question, Francesco, and then...
Francesco Papadia from Bruegel. And my question is basically for Mr. Alvarez, but maybe may interest others. If I understood you well, you said, well, banks are not against the capital market union. It's not that the banking services are a substitute for capital market services. We like banking union. We can make money out of capital market union. But my question is this true for all banks? I mean, this is probably true for a bank like Santander and the likes, but it may not be true for all banks. And for maybe not for all institutions, also for some non-banks may not be. Could that be the reason why it's so difficult to do capital market union? That it's a bit like the Gilets jaunes, when you try to do something for the climate, you will hit someone who will go on the street. I mean, banks are not likely to go to the streets, but they could have the similar effect. Thank you.
Great. Okay, thank you very much. Very short answers, because we're already running late. And whoever wants to pick.
In Paris, we had Mr. Christian Noyer suggesting ideas kind of along those lines earlier this year. I think the experience is that if it doesn't work for the single market, it's probably not going to work to go very far. So for supervision, I think the big difference, I emphasize that, the big difference we have between the debate now and the debate we used to have is that we have a proof of concept. We know that the prudential supervision by the SSM works reasonably well. We will see AMLA in action. I expect it to work reasonably well, at least in comparison with the organization it replaces. And I think this is what should drive the policy thinking. We're no longer experimenting the way we used to be. We have proofs of concept. The second question was about the competitiveness mandate. I think many people in the UK are very worried about where that could lead the UK. The reason we have financial regulation in general is not to stimulate the financial market. It's because we have financial stability issues and investor consumer protection issues, asymmetries of information. I personally am very skeptical that we should complicate the mandate of regulators in a way that would drive them away from their core function, which are these two things, financial stability and mitigating asymmetries of information.
Thank you.
Just quickly on Basel III. I mean, Basel III is about financial stability. I mean, let's be clear, that's why it was done. But consistent implementation is also about financial stability. It's always presented as a level playing field issue, but no, it's actually, to have the system stable, it has to be implemented consistently. So this is why we are all waiting for one rather large participant to come forward. I believe they will come forward with implementation because actually US banks, paradoxically, given the debate in the US, have most to lose if from inconsistent application, because they could be denied access to the global customer base on that basis. So I think we are confident the US will do it. So therefore we're not sitting around worrying about situations where they don't.
All right. We actually have to end here because we need to leave the room for the next panel. So I think the question that Francesco asked me, we may answer bilaterally. Unfortunately, we've taken even more of the time that was already more than the time that originally was supposed to be allocated to this panel. But thank you so much for having been with us, for all the questions, and pick up your memo on your way out or on our website. And thank you again.